3 long-term stocks that I'm keeping a close eye on heading into January 2019. Let's get started. What's up, everybody? My name is Ala and welcome to my world of stocks. If you enjoy this series, could you please do me a favor? Support the channel just by hitting the like button. It really helps the channel survive and compete against those bigger YouTubers out there, and I really appreciate all that support. Having said that, this series tends to bring in a lot of new viewers and also a lot of negativity and a lot of angry comments and things like that. So I wanted to just give you a quick disclaimer and give you some context behind this series and why I do these videos. But if you want to skip ahead, I'll leave some timestamps for you down in the comment section. But again, if you're going to be leaving like angry comments or hitting the dislike, then please just stick around for a second so that I can explain this entire series. Okay guys, if you're new to the channel, I just want to say that I'm a long-term investor and I believe in dollar cost averaging. So it's perfectly fine to leave critical comments and things like that. But if you're going to leave like angry comments or hate comments, all I ask is that you please research what dollar cost averaging is before you leave those angry comments, because from what I've noticed, a lot of people that call me an idiot for buying stocks when they're going down in price, I feel they just don't really understand what dollar cost averaging is. In that type of strategy, I'm still buying stocks even when they go down in price. In fact, I'm actually buying more. I get to buy more shares with that type of strategy. I'm not going to go into how it all works and all that kind of stuff because that's not what this video is about. But I just want you to just kind of quickly research that and know what that strategy is before you criticize it. And I say you, I mean you in general. I'm not saying you specifically. Over 90% of my viewers are amazing people that support the channel, leave really nice comments, and really keep me going on YouTube. But there is like another, I don't know, 10% or something like that leave negative comments, leave dislikes and things like that. And from what I've seen, they just don't really understand what type of investor I am. And the key word here is investor, because I believe in investing in companies long term. I do not believe in trading the market short term. You know, just a few months ago, people were very bullish on a lot of different stocks, and some of those have dropped by 20, 30, 40, even 50%. In fact, stocks number 2 and number 3 in this video are down around 50% from their highs. And people that used to claim to be long-term investors all of a sudden are short-term market traders, and they're trying to predict the market and trying to predict when the next crash is, when the next recession is, and that's completely fine. I don't have any problem with that. But the people that leave angry comments talking about that kind of stuff need to understand that we can all have different strategies, and that's perfectly fine. I personally, I'm being completely honest with you guys, I am not good at timing the market. In fact, I suck at it. I suck at timing the market. And if I try to predict where the bottom is, if I try to predict when the next recession is, I can almost guarantee you that I will get it wrong. I will not be able to accurately predict it. And it's not as easy as everybody tries to make it out to be. Yes, you can use technical analysis to get a better approximation, but it's not as easy as people make it sound. And at the end of the day, I sleep much better at night knowing that I'm not trying to make any kind of predictions. I'm just investing in good companies at what I think are fair valuations for the long term. Having said all of that, there is obviously a lot of market volatility right now, a lot of fear, a lot of macroeconomic reasons to be bearish on the stock market. And the stocks that I talk about today, they're probably gonna keep going down in price. I would not be surprised at all if by the time you watch this video, these stocks are down quite a bit from the time of this recording. But this series that I do, this 3 stocks to buy ? Series, is not a picks or recommendation series. There's a reason why I have a question mark at the end and not an exclamation mark. I'm not telling anyone, nobody's forcing you to buy anything. If you want to wait, then wait. There's no reason to get angry or get really upset or blame other people for any kind of stock market decisions that you make. You always need to do your own research and make your own decisions. This is just somewhere to start. And with this series, I come up with 3 different stocks every single month. And you know, sometimes there's some overlap, but for the most part, I'm usually talking about different stocks every single month. It's not an easy thing to do. And all I'm doing is sharing my bullish opinion on them for the long term. So for anybody to come and like criticize me for that, they're just not really focusing on the context of the series. And I've explained it many times that when I do these videos, I'm looking long term and these are stocks that I'm tracking. It doesn't necessarily mean that I'm buying them, but I am tracking them with the idea of buying them if they're at the right price, if I can get them at the right price. And I cover all of that kind of stuff in these videos. So the same thing goes for today's 3 stocks. I'm not invested in any of them. I am thinking about investing in them. That's why there's a question mark at the end of the title. And if I get the right price, I will probably jump into these if I can get the right price. But we're going to talk about that. We talk about that every month. So anyway, with all that said, thank you for sticking around and for hearing me blabber on. And I know it's kind of annoying, but I have to give these explanations in hopes that it will limit the amount of dislikes I get, the amount of angry comments I get, the amount of people calling me all kinds of really bad names and things like that. It's not a good thing. There's enough negativity out in the market right now for us to be fighting and arguing about all these kind of things and to be name calling and stuff like that. Okay guys, hopefully all of that stuff made sense, but let's go ahead and start. So looking at stock number 1 today that we're taking a look at, we've got Visa, ticker symbol V. Now this is a company that I've always been interested in, but I never really gave them a lot of attention and never really researched them further. So today we're going to be taking a closer look. Now you guys know that I'm trying to be a little bit more of a dividend growth investor. And as far as Visa goes as a dividend growth stock, it's not going to have as explosive numbers as some other companies out there, but I find that they're pretty reliable in every different aspect of the stock and the company, but just in kind of smaller amounts. I know that sounds a little confusing, but I'm going to explain as we go through here. But first, let's take a look at their stock and their dividend. Now, in the past 5 years, they're up almost 150%. Year to date, they're up over 15%, and they currently trade for around $130 per share. However, they are down about 13% from their 52-week high. Still, at these prices, I feel that Visa is a little high, considering that they've been performing pretty well lately when a lot of other stocks have been absolutely crashing. So I would like to see them dip a little bit more before their price gets more attractive to me. Now their dividend yield is pretty low at about 0.75% at the time of this recording, but their payout ratio is fantastic at less than 20%. They have a decade of consistent growth and a 5-year growth rate at above 20%. So this is likely a sustainable dividend that should be growing nicely in the future. Now if you don't know what Visa does, then you probably have a horrible credit score. Or maybe you have a really good credit score. Touche. Anyways, Visa is essentially a payment services company. Now, many people get confused with Visa and they think that they carry the same risks as banks, like changes in interest rates or customers not paying back their debt. But in reality, Visa is just a sort of middleman. If you want to access funds from your bank account or credit card, chances are pretty high that you're using a Visa card or a Visa service to actually use those funds that are usually supplied by a bank or a financial institution. So the bank is really the one taking all the risk, and then they just pay a fee to Visa whenever customers use their payment services. And so you might be asking, well, because Visa is already so commonly used, how much room for growth can there really be? Well, there's actually quite a bit of room for growth because as we continue to see cash used less and less, and as we see the rise of online shopping, Visa plays a major role in that, and they pretty much get to collect a little fee every time you use their Visa services. In fact, when looking at global retail sales, only around 12% of them are actually done online. And even looking at some individual markets that are very large, like the US or China, only around 10% of US sales are done online. And then looking at China, their e-commerce market is projected to grow from around 1 trillion this year to around 1.8 trillion in 2022. And currently less than 40% of the Chinese population even shop online. So the e-commerce market is really going to see tremendous growth. And while Visa still rakes in revenue from traditional retail, I think over time we will continue to see cash used less and payment cards like Visa cards actually used more. And when looking at the most recent quarter for Visa, operating revenue increased in the double digits by 12% year over year, with GAAP net income and EPS both up very impressively at over 50%. And even adjusted, it still comes in at around 30% each. So the company is still growing at a pretty nice rate. So if you combine the fact that they operate in a very fast growing market and the fact that they're already an enormous company that is still growing revenues by double digits, and you combine that with their dividend that isn't necessarily a high yield but is growing fast and has all the necessary components to keep growing in the future, then I think you essentially get a pretty reliable dividend growth stock for the long term, and that's just how I see it personally. I do, however, think that their valuation is a little expensive at a trailing PE of over 30, and some of their other ratios are pretty high as well according to Yahoo Finance, so I'll probably wait for a bigger dip during this market volatility, but it's definitely a stock that I wouldn't mind picking up myself if the price is right. Okay guys, now last month we decided to include a Chinese stock because some Chinese stocks are down like 30 to 50%. I mean, they're down massively from their recent highs. So last month we took a look at Tencent. This month we're gonna take a look at JD.com, ticker symbol JD. Now they're down over 14% in the last 5 years, down over 48% year to date, and down over 57% from their 52-week high of $50 per share, now trading at around $20 per share. Now, if you've never heard of them, they're one of the biggest online retailers in China that uses a combination of artificial intelligence, blockchain technology, robots, and drones to comprise a high-tech platform and delivery system to reach more customers more efficiently. Now, many people refer to Alibaba as the Amazon of China, and while I don't disagree with that statement, considering that Alibaba does control over 50% of e-commerce sales in China, according to Statista.com, it should still be noted that when looking at the business to consumer online market, JD's market share has risen from 18% to 33% in the last 3 years, while Alibaba's Tmall dropped from around 55% to 51%, according to the Motley Fool. I know this sounds a little confusing, but the thing you have to keep in mind is that Alibaba doesn't have the same model as something like Amazon, who takes full control of its business to consumer platform. Instead, Alibaba has really much more to their company, but they also focus on business to business, consumer to consumer, and then also business to consumer. They even invest in like traditional brick and mortar retail as well. So it's just a little different. I don't know if I would necessarily call Alibaba the Amazon of China. I think I'd feel more comfortable calling JD.com the Amazon of China. And while Alibaba is considered a bigger company with many different parts to its ecosystem, JD has some very lucrative partnerships as well with Tencent, Baidu, and even Walmart that have helped JD actually bring in more revenue than Alibaba. In fact, in the last quarter, JD brought in over $15 billion at an increase of over 25% year over year, while Alibaba brought in much less at over $12 billion, which is still impressive, but it's a difference of close to $3 billion. But don't get me wrong, I'm not saying this because I'm bearish on Alibaba. In fact, I personally want to start buying Alibaba sooner than JD.com, but this is just to break the misconception that JD is a horrible investment just because Alibaba is out there, which I don't really believe is accurate. Having said that, JD's non-GAAP EPS came in close to 50% lower year over year, which absolutely spooked investors even further. And with all the trade war stuff going on, I think JD is likely to drop further in their price, at least in the short term. But I also think that the drop in earnings has to do with JD reinvesting in the business, which is very similar to what Amazon used to do until they finally started raking in very large profits. On top of that, I'm also optimistic that the trade war stuff will pass eventually. I'm optimistic that the Chinese economy will start to recover. I know they're still doing very well, but in terms of like slowing down, and at which point I do think that JD will become a very lucrative business in the long run, especially as they benefit from that Chinese e-commerce market that we talked about earlier that is projected to rise to almost $2 trillion by 2022. And all of this may reward long-term minded investors in JD.com, and that's why it's number 2 on this month's video. Okay guys, finishing up here with stock number 3, we've got a very controversial stock, and that's Micron, ticker symbol MU. Honestly, just this pick will probably get me at least like 5 to 10 dislikes, assuming that my intro earlier didn't get like even more. But Micron is just so hated, and at this point, I'm starting to think that the stock is finally reaching oversold territory. Having said that, I gotta give you guys a quick disclaimer. They are literally about to release earnings. By the time you watch this video, earnings are probably out already, and a lot of people are predicting bad earnings. I don't know how I necessarily feel. I think that they've already kind of lowered the bar a lot, but a lot of people are predicting very weak earnings, and this could send the stock down even more. So just keep in mind, we're gonna talk about the stock price right now, but just keep in mind that it's probably much lower by the time you watch this video, or maybe earnings came out and maybe earnings were actually good and the stocks started to finally see some recovery. But anyway, just keep that in mind. The price is likely a lot different than what we're gonna talk about right now. Now, the stock is still up close to 50% in the past 5 years, but year to date, they're down over 17%. And from their recent high of almost $65, they're now down close to 50% as they currently trade in the low $30 range. Personally, what it would take for me to start buying Micron, I would like to see it dip to the $20 range. I don't know if it'll reach there. I think this earnings could potentially help it, could potentially drag it down lower and help it get close to that if the earnings are weak. But if earnings are strong, then I don't know. I mean, I might not even see that price. But that's just kind of what I'd like to see, just because there's so much negativity surrounding this stock. I'm a little hesitant to jump in. Now, if you've never heard of Micron, they are a memory developer, manufacturer, and seller of mostly DRAM and NAND products. DRAM being volatile memory that only saves data when it has power. So think of the RAM being used in your computer or your smartphone, or maybe even integrated into your graphics cards. While NAND is a type of flash memory that can store data even when it is turned off. So think of like a USB flash drive, and that type of technology is also often used in solid state drives as well. But DRAM makes up the majority of Micron's revenue at over 70%. Now, thanks to all of this market volatility, Micron is currently trading at an insanely low PE ratio of less than 3. And when you factor in future growth, their PEG ratio is at 0.14. That is so incredibly low. I can't really think of any other stock that has been disrespected this badly by Wall Street. I mean, their ratios are so low, and they're also trading lower than their 50 and 200-day moving averages as well. So why then is there so much negativity being priced into Micron? Is the company performing bad? Well, let's take a look at their most recent earnings. In their fiscal fourth quarter, they beat revenue estimates, they beat earnings estimates. Revenue increased 38% year over year, adjusted net income increased by 80% year over year, and adjusted EPS increased 75% at $3.53 per share. I personally cannot think of any other company that grew by this much that trades at a PE ratio of less than 3. That seems insane to me. So why then is the stock dropping by so much? Well, for starters, guidance was weaker than expected. Wall Street was looking for guidance of $8.4 billion in revenue and EPS of $3.06 for the next quarter. But Micron guided lower than that, with revenue at $7.9 to $8.3 billion and EPS of $2.95 at the midpoint. That's probably due to DRAM and NAND prices dropping, but at least that lowered guidance may now be reflected in the stock price, which should help them if earnings do in fact come out weak. But speaking of weaker DRAM and NAND prices, that's been the real story behind Micron's drop from grace. See, most people consider Micron as a commodity stock that is very cyclical in nature, because when memory demand goes up, prices go up and MU stock soars. And if memory chips are considered a commodity, meaning that they're all very similar and not specialized, then many companies can build them, which will drive up supply and lead to an oversupply, which leads to lower chip prices and MU stock takes a hit. And that's all been true in the past, but investors on the bull camp would argue that things are starting to look different now, because Micron claims that their products are much more customized and offer competitive advantages, like for example their GDDR6 chips having the fastest graphics bandwidth. There are fewer memory chip makers in the game now, with Samsung, SK Hynix, and Micron making up 90% of the DRAM market, all of which, by the way, have stated that they're making changes to ensure that they don't flood the market with an oversupply of chips, and that there will be sustained growth from some mega trend markets like artificial intelligence, the Internet of Things, cloud computing, autonomous driving, VR and AR, and 5G wireless technology. I do personally think that there is some truth to that, but I'm not exactly sure if that's just going to completely wipe away the cyclical nature of this stock. And especially when you consider the fact that some of these megatrend markets like 5G technology, autonomous driving, those markets haven't really come online fully yet. So we're still going to have to wait a little bit. But I think that in the coming years, those are definitely the future. So that's why I kind of see Micron as a long-term play, more so than maybe like a short-term kind of bet. And speaking of the short term, I think there's really two things that we can look at here as potential catalysts for kind of dragging down Micron a little further, which would actually make it a better price for someone like me who hasn't invested in there yet. But I'm sorry for kind of taking that angle, because I know a lot of you are invested in Micron. You probably don't want to hear me, asking for lower prices. You definitely want this stock to recover. So I apologize for kind of giving that view, but I'm just trying to be honest with you guys. Now, as far as those two concerns go, one is that there is increased competition coming from China, and then the other is, of course, dropping memory chip prices. Now, starting with the former, we know that China is investing heavily into supplying memory chips themselves through a number of different suppliers, but some analysts from firms like JP Morgan Chase and Morgan Stanley feel that those threats are overblown because the suppliers are at least 1 or 2 generations behind Micron in terms of technology. The other concern, however, is that memory prices are falling, and when we look at DRAMExchange.com, which tracks the prices of memory chips, they mentioned in their report back in October that Q3 DRAM prices only increased by 1 to 2% quarter over quarter and are likely to drop by 5% in Q4. And when looking at NAND prices, those have already been declining for a while, and they dropped again in Q3 by around 10% and are expected to drop another 10 to 15% in Q4. And even looking at 2019 projections, those are still kind of negative, with DRAM being expected to drop by around 15 to 20%, which could be very significant, especially if we experience any kind of recession or economic slowdown. Still, we're talking about a very profitable company with a gross margin above 60% that brought in over $3 billion in free cash flow this last quarter. They reduced their debt by $2.7 billion, and they're also spending $10 billion in a share buyback program that would equate to around 20% of the company at these current prices, and they're still trading at a very low valuation. Now, according to CSImarkets.com, the semiconductor industry is trading at an average PE of over 15, while Micron is at less than 3. So I really think that a lot of this negativity is either already baked into the price or is currently still being baked into it right now. And it's not helping that we're going through all of this market volatility, that people are screaming for a recession, a market crash. All of this is just kind of accumulating, and it's like, it's elevating the impact of the concerns that Micron already has, which is, memory prices and then growing competition and things like that. So I think that in the short term, anything is possible. This stock could go down lower. Micron has never really been a stock that I was extremely eager to jump into, but at these prices, I mean, it's just getting so attractive to me. And I really do feel like they will have a very bright future. I know some people disagree with that, but I mean, that's a conversation that we could have for a very long time. Having said that, we'll have to take a look at earnings. I think earnings will give us a clue as to what's going to happen in the future, and we'll have to go from there. I may even have to do an update video on Micron very soon, depending on how this earnings goes. But anyway, those are the stocks that I'm kind of keeping a close eye on right now, heading into January 2019. Those are the stocks that I'm tracking. And of course, there's other stocks as well, but I try to give you guys new stocks every month. If you guys did enjoy this video, please hit the like button. I really do feel like I'm probably going to get a lot of dislikes and a lot of angry comments, especially because I try to explain myself in the beginning and people tend to not really like it when you have a different strategy from theirs. But it is what it is. Thank you for all the support, guys. Most of you are really awesome, and I really appreciate everything. I hope you all have a wonderful, beautiful day. I'll catch you in the next video. Take care. Bye-bye.